For over a century, high-net-worth individuals manage tax exposure by moving to Western Europe. Right now, that strategy is breaking down. In the United Kingdom, the government abolished its century-old non-domicile taxpayer regime on April 6, 2025. New arrivals now receive a brief 4-year exemption on foreign income before full worldwide taxation applies. Italy has also significantly raised its barriers. The entry cost for its popular flat tax regime for new residents climbed over several years, tripling to a permanent €300,000 annually. Further north, Switzerland has tightened its lump sum tax framework at the federal level, with several cantons choosing to abolish the structure entirely. This collective shift means the high-access, low-cost model once associated with Western Europe is no longer a given. It has created a landscape where the value of a jurisdiction is now measured against a much higher price of entry. Turkey is the jurisdiction currently filling that void. While Western Europe tightens its rules, Turkey has maintained a tax structure that fits the requirements of internationally mobile wealth. The entry requirement is grounded in a straightforward domestic test. You establish tax residency either by spending more than 183 days inside the country during a single calendar year, or by formally registering your permanent domicile there. This provides immediate clarity. Unlike certain European models, there is no ambiguous center of vital interests test to pass. You do not have to litigate a complex statutory framework just to prove where you live. Once residency is established, a specific wealth protection mechanism applies. Foreign-sourced passive income, including dividends, capital gains, and international interest, remains outside the Turkish Revenue Administration's reach, provided those funds are not brought into Turkey. While domestic law doesn't use the formal label of a remittance basis election, the practical outcome is identical. It creates an operational barrier against taxation on foreign wealth, but with less bureaucratic friction than many traditional alternatives. Turkey's framework extends beyond parking passive wealth. Article 33 is a hard statutory exemption embedded within the income tax law, designed to attract active founders, consultants, and developers. This is how the mechanics of Article 33 work. If you render services abroad and invoice foreign clients, the law guarantees a Turkey's $250,000 real estate citizenship by investment pathway introduces a different strategy for residency. It allows for an acquisition that grants a passport in approximately 3 to 6 months. This passport provides visa-free or visa-on-arrival access to over 100 countries, including key economic hubs like Japan, South Korea, and Singapore. More importantly, acquiring citizenship changes the residency rules. If a Turkish citizen makes Istanbul their genuine home, the 183-day physical presence requirement is eliminated for maintaining tax status. This removes the vulnerability of managing an annual day count timer. Citizenship allows an individual to build a permanent, unrestricted base rather than a temporary retreat. Turkey is not the correct fit for every profile. If you rely on a complex offshore trust structure and want zero compliance overhead, paying Italy's €300,000 annual premium remains the clearest solution. Likewise, if your strategy demands the absolute legal certainty of a formal statutory remittance basis regime, jurisdictions like Ireland or Malta remain the appropriate choice. The ideal candidate for the Turkish structure is the internationally active professional. If you require a base in a first-class city, a second passport, and specific exemptions on active income, the legal framework aligns with your needs. When mapped against the rising costs across Europe, Turkey in 2026 is one of the most undervalued residency structures currently available. If you are evaluating a move for 2026, the next step is to run a structured analysis of your specific income profile against Turkish domestic law and your applicable treaty network. Our team at OZM Consultancy specializes in this type of cross-border optimization. Click the link in the description to access our full 8-country comparison guide and reach out to our advisory team to begin your analysis.